Nothing in this program should be considered investment advice. It is for educational purposes only. Please hit pause and read this disclaimer in full.
You know, there's always the new generation that, without realizing it or not, is consumed with pride because they believe that they were born on third base. They think they hit a triple without understanding they happen to be at the right place at the right time, and their arrogance causes them to not pay attention to the wisdom and the lessons of the past.
Hello, everyone. Welcome very sincerely to this episode of Finance U. I'm your host, Chris Martinson. I'm back with Paul Kiker of Kiker Wealth Management. How you doing, Paul?
I'm good, Chris. Good to see you today.
Well, I'm glad that you have that particular poster over the back of your head, because I want to talk about the AI bubble, this bubble thing that we've gotten, and it's a comprehensive bubble. I don't want to just pin it all on the AI. Also, remember we talked about the jobless recovery? Now we have to talk about the freightless recovery as well. Yeah. So there's some other data I want to get to on that, but I've really been struggling watching this. So I'm an analyst at heart, Paul. I like to understand things. So it was just announced the other day that, there was another deal. Amazon has a $38 billion deal with OpenAI. I couldn't find any, who's paying who? For what? Over what terms? Like $38 billion for, I couldn't find out any of the details, right? It's kind of vague.
Kind of vague, yeah.
So I dug into it more and more, and it turns out I'm not the only person struggling with trying to understand what the heck's going on. It turns out everybody is. So I thought we could unpack that for people here today, because if it's true that this is all a big giant circular funding bubble, then people need to know about that, because we've seen this before when, the so-called internet bubble burst in 2000. So kind of has some similar flavors to that.
It does. And what's interesting to me is I love the analyst community because they're not yes people. They will argue, they will debate, they'll get into the math. And this is the one thing that I've not seen anybody challenge on this circular financing issue yet. Everybody's like, how in the world are they, is nobody paying attention to this right now? I haven't had one single explanation outside of this circular finance to protect everybody's stock price and keep this narrative going in the short run.
All right. You know me, I like to frame this. Let's frame the conversation real quick. First, definition time. This is the best definition of a bubble I've ever come across, and it's in the crash course. And it is that a bubble exists when asset prices rise beyond what incomes can sustain.
Mm-hmm. That's a good definition.
So on your history of bubbles back there, tulip bulbs, right? The tulip bulbs, the prices of tulip bulbs shot way up. So the asset price, the asset being the tulip bulb, went pretty high. Unfortunately, there was only so much you could actually sell the offspring of that bulb for, and that was the income part of the story. So we've seen this with railroads, we've seen this with the South Sea Company, we've seen this over and over again. It's an entrenched human thing. Now, so a bubble exists when asset prices rise beyond what incomes can sustain. Now we need to understand, well, you need two conditions for a bubble. So what are those? Condition one, you need a story. It's a story. They're not making any more land, These are extremely rare bulbs. Everybody wants them. Eyeballs. You need a story, and the story doesn't even have to be sensible. And you need ample credit, because you can't fuel a bubble off of cash. Can't be done. You need somebody out there lending credit into this whole story. So the question is, do we have that situation going on? Well, to their benefit, to their credit, Paul, this is way more complicated than, say, Lucent vendor financing in the year 2000 or 1999, right? These are the kind of charts they have to make. This is Bloomberg. It's like NVIDIA is a $4.5 trillion company at the center of this. You got all these different lines running around, and red is hardware or software, and blue is investment money. You see the investment money is flowing within and around and amongst each other. It's going every which way. You got services, venture capital. So this is all like it's that complicated. But in this case, you might have OpenAI nominally valued at $500 billion, but who knows, right? It's not a public company, and they've lost money every day that they've been open. So value it how you will. And so how do you begin to make sense of this? You know, who's paying whom? Where is all this money coming from? I can't figure it out. I've tried. It's tricky, too tricky, right?
It's bad when you have to it's so complicated you have to try to put a mind map together, because usually that visual will help explain where it's coming from, and you still can't figure it out. Yeah.
So I think the Wall Street Journal, they did a pretty good job last week on this, and this is the chart they came up with. It's a little bit cleaner.
Mm-hmm. Wow.
But those are your big companies, right? OpenAI, Microsoft, NVIDIA, CoreWeave, AMD, and Oracle. And so then you have chip purchases. So this is the light blue line. So chip purchases are being made all over the place. And by the way, AMD did this big old deal with OpenAI where they said, hey, OpenAI, we'll allow you to buy our stock warrants for up to 10% of AMD for a penny a share.
Oh, my.
And you know what? The stock didn't tank or crater on that news when they just diluted existing shareholders by this massive amount. And so basically, OpenAI can exercise those warrants, sell the stock, and then use that money to buy chips from AMD, because AMD is that desperate to get business with OpenAI.
Wow.
Right? But they're doing revenue sharing, equity investments. It just goes every which way. So even the Wall Street Journal, I said, is struggling to describe and explain this. And so, they got very good reporters, and they've got, they're able to dig through it. So this is from that Wall Street Journal article. They said here, quote, circularity has become a buzzword in AI deals. Some investors have drawn comparisons between the mega deals of today and some excesses of the original dot-com bubble. But today, the dollars are at stake are exponentially bigger. The deal's way more complex, and the money trail harder to follow. Absolutely true. Broadly speaking, circular financing often goes something like this. One company pays money to another as part of a transaction, then the other company turns around and buys the first company's products or services. Without the initial transaction, the other company might not be able to make the purchase. The funding mechanism could take the form of an investment, a loan, a lease, something else, and during the 90s and 2000s, such dependency loops mainly consisted of telecom equipment makers lending money or extending credit. There's the credit. You need the credit for a bubble. To customers, so the customers could afford to buy their gear. In those days, this was widely referred to as vendor financing. But today, Paul, it's just way more complicated. Like, I can't make sense of this, which is always a problem for me.
No, it's certainly organized. It's certainly organized between them in collusion between each other, and that just doesn't make sense. Where does it go? Then you've got the destruction. Like, at this point, what? These chips are going to be viable for 3 years? Is that what it is? So you're going to have to keep this going along, and then supporting each other's stock prices helps continue their ability to add further leverage on top of it.
Well, at the heart of this is this company, OpenAI. So I don't know what it means when they signed. What does that mean? They've signed a $500 billion Stargate deal, $100 billion with NVIDIA, $100 billion with AMD. You start adding it up. It turns out that they're actually up to about 1.4 trillion by another measure that I was looking at. And they signed all these deals. Paul, this company loses money. The revenue is estimated to be $13 billion right now. How do you sign a $1.4 trillion of deals on 13? Well, let's call it 14 billion so I can do the math in my head.
Yeah.
You have 1/1000th of the revenue, which you're burning like crazy, to support $1.4 trillion of deals?
The math doesn't math.
You've seen this before, right?
Mm-hmm. It's just smaller versions. Yeah, this is my 27th year, so I've seen this in cycles before. Internet bubble, late 1990s, housing bubble, circular financing, self-dealing. This is new, but it's broad in this circumstance.
So, was it last time we talked? But anyway, the number of companies in the S&P 500 that are actually down year over year is pretty extensive. In fact, we've talked about how the whole thing is really being held up by just a few companies, right? Mm-hmm. So right now, the top 10 companies are 42% of the S&P 500. And it turns out that just the top 5 of those are 32% of the S&P 500 and 53% of the NASDAQ, right? Just NVIDIA, Microsoft, Apple, Alphabet, which is Google, and Amazon. So just those five, that's it. And each one of those is pretty heavily sort of implicated in this AI bubble that we're dealing with right now. And that's an extraordinary concentration. So it turns out this whole thing is really just driven just by these companies. Top 10 for sure. Top 5 really, even more specifically.
Yeah. The highest concentration that we've ever seen in history, correct?
Correct.
Yeah. And I've got another good chart here to go along with that, or a post by Michael Arowet, which is appropriate, because if you look at this, and this goes along with different strategies that you have. So Michael Arowet posts, why is it even called the S&P 500? Right. So yep. Here's your Magnificent Seven since 2015, and here's the other S&P 493. Right. So you've got if you're properly diversified, you're struggling. If you have value strategies, dividend strategies, anything else at this point, you're struggling. And of course, none of it makes sense, because this is just, this bubble just continues to feed itself over here. And the narrative gets even more complex and less understandable in every day that goes by. It's just, it's completely unsustainable at this point. Are we just going to have 7 companies that own it all before this is over? I mean, that's the ultimate end game at this point.
Well, isn't that, remember, who was it? I remember he was on Joe Rogan, and he was talking about how the Biden administration wanted to just pick 2 or 3 top companies and work with them.
Andreessen, that's exactly who it was.
Yeah, yep. Yeah. Well, it looks like it's happening anyway.
It sure
I remember
does.
all these people were offended, like, oh my gosh, the Biden administration is going to use the censorship industrial complex and pick a few winners, and it sounded awful, and now it's happening anyway.
Yeah.
So
and then yesterday you have Treasury Secretary Bessent comes out and states, "Oh, this is going to be great. It's going to be great for Wall Street and Main Street." Well, what are you going to do? Just protect the gap that Wall Street has over Main Street, and they all go higher, but it doesn't solve any of the problems out there? The large majority of the companies are not participating. And this is an unusual circumstance, too, with your consumer staple companies. A large majority of them are down 20 to 50% from their highs right now. I mean, that's the foundational part of the economy. And they're just being taken out to the woodshed and beaten. One, is that just investors that are selling those assets to chase, which that's further going to exacerbate this bubble? Or have we reached a point to where the middle class has just been absolutely wiped out and the consumer economy is over?
Markets are facing heightened uncertainty, and thoughtful portfolio management has never been more important. If your current strategy relies solely on passive investing or diversification without active oversight, it may be time to consider a different approach. At Peak Financial Investing, we connect you with experienced wealth managers who actively manage portfolios using disciplined, research-driven strategies designed to adapt to evolving market conditions. Our focus is on helping clients navigate volatility with clarity and confidence. While no investment strategy can guarantee results or eliminate risk, we believe that preparation and active management can make a meaningful difference over time. Visit peakfinancialinvesting.com to schedule a complimentary consultation and explore whether our approach aligns with your goals. I'm Dr. Chris Martinson, and I am proud to support Peak Financial Investing. This is not a guarantee of future performance, but a call to take your financial planning seriously. Again, that's peakfinancialinvesting.com. Investing, of course, involves risk, including the potential loss of principal. Past performance is not indicative of future results. Please consult with a qualified advisor before making investment decisions. So, I've asked this question many times. You're going to have to show me the money, right? For any new technology, I understand the story is AI is going to transform everything. It's going to disrupt things. It's going to transform everything. It's going to be embedded in everything. So it's an everything story. I'm like, great. What's the use case? How does that make more money for the companies involved, right? Mm-hmm. And when you net it out, it turns out some companies are going to do well because they'll be able to really streamline, be far more efficient. That's true. But they're going to need fewer people working for them. Mm-hmm. So you have this kind of an offset to the overall larger economy. right? So unless we're all just going to be in the business of making and selling information to each other,
right?
Where is it? I don't get the business case yet, right? And so Paul, I ran into this for years, when Ethereum first came out, right? One of the cryptocurrencies, and people are like, oh, look at all these use cases. It's going to completely take over smart contracting and transform A, B, C, D, E. And I was like, well, that sounds very cool. Well, here we are 15 years later, and I don't have a single use case, to look at.
Well, nobody's implemented it. When you look at those smart contracts, if you were to take real estate titling, for example, and put it on the Ethereum platform, then one, you could never there's no need for your title insurance, because once you've done the research, you've got it in place. You've got the blockchain transactions where you can see it. So the fraud's going to pop up if it's there, and nobody can go steal your title. And I was like, oh my gosh, there's so many areas that this can be implemented in. None. Nobody's implementing it for what reason, right? It was a great story, but and I know now, from what I understand, oil tankers, those contracts are put on the Ethereum platform from a smart contract standpoint, but it hasn't worked its way into the rest of society for whatever reason. If it was that good, it would be there. Or you've got these legacy businesses that have enough influence at the political level where they're keeping it from happening for now. I don't understand why it has not been implemented.
All right. Well, I don't. If it's when technologies are really good, they get implemented, right? Usually, right? That's kind of the nature of it. Almost impossible to stop them from being implemented. So here's what I yesterday, Paul, when I left, I was going to call you, and because this really bothered me when Amazon surged 6% after announcing this mysterious $38 billion deal with OpenAI. And remember, so this is a $2.4 trillion company worth, market cap. So that's the surge is larger than the deal,
Far
right?
larger.
So that's why I say it's not rational. It's just not rational. If so 10% would be 240 billion. So this would be 120 billion plus a little more. I'll say just off the top of my head, 140 billion dollars of market cap tacked on because of a $38 billion deal. It doesn't make any sense whatsoever. Besides, nobody even knows what the deal is. Nobody actually knows what the deal is, right? So just yesterday, Sam Altman, CEO of OpenAI, famously kind of thin-skinned kind of a guy, maybe not the smoothest on his feet, but apparently he was in the Big G2 podcast, Big BG2 podcast, and this Gerstner asked him, hey, how can a company with 13 billion in revenues make 1.4 trillion of spend commitments? You've heard the criticism, Sam, right? And then Altman just got prickly and he said, if you want to sell your shares, I'll find you a buyer. Enough. That's it. It's a simple question of a CEO. Hey, how does this pencil out, dude? What's your plan? And he should have a good story. He had no story. He said, if you want to get out of your shares, good. I'm done. Enough. Like he couldn't handle the question, right?
That response, I mean, the CEO, and how can you invest into a company as a major investor if your CEO cannot articulate the business model to a simple question like that everybody's going to be asking from a mathematical standpoint? And the only response is to deflect it, try to gaslight the individual and belittle them in that manner. That, any of us, if we're asking a question of somebody that we were doing business with and they can't answer it and they responded back trying to attack you, would say, something's going on under the surface here. Well, we're not getting the whole truth. I mean, that's a horrific response for somebody that has to be able to communicate their vision at the level of CEO.
Totally agree. This is sketchy. Totally sketchy. So, if I could, I want to review one of my favorite bubbles, the South Sea bubble. Ruined a lot of people's fortunes, including Newton. Yeah, that one.
That's
the blue
South
one.
Sea right there in the 1720s.
Yeah, so one of my favorite things is, So they said here, quote, as the South Sea stock soared, numerous other joint stock companies emerged, joint stock companies. Hey, we're in with this, like that circular bubble thing, to capitalize on the investor mania. Many were fraudulent ventures designed to attract capital. So say it ain't so. A few notorious examples include that it was going to supply the town of Deal with fresh water. It was for trading in hair. It was for assuring seamen's wages. It was for importing pitch and tar from North Britain in America. It was for insuring horses. It was for improving the art of making soap, for improving gardens. All these stories, Paul, all these stories, ample credit, right? For the importing of walnut trees from Virginia. But my favorite, and I think this is what Sam Altman just told us, the most famous of all is that the scheme was, quote, for carrying on an undertaking of great advantage, but nobody to know what it is. I love that quote.
I love that too. And that's just a classic quote, an example that for all the knowledge and the information that we have access to today, we think we're so much smarter than all of humanity throughout history. But the one thing that hasn't changed is our emotional and cognitive biases. And even though that we know more about them today than we've ever known in the past, just like Rolf Dobelli's book, The Art of Thinking Clearly, that's something that doesn't change. That's why we continue to have these cycles throughout time and these fourth turnings. You know, there's always the new generation that, without realizing it or not, it is consumed with pride because they believe that the fact that they were born on third base, they think they hit a triple without understanding they happen to be at the right place at the right time, and their arrogance causes them to not pay attention to the wisdom in the lessons of the past.
Enough, says Sam.
Enough.
Enough. He should have just said, it is an extraordinary undertaking, but nobody to know what it is, right? You know, it's no, we're there. I am, Paul, this is, I've never seen a bubble quite as magnificent as this, quite as large. This is, of course, belongs, like all bubbles, to the Federal Reserve, because they were the ones supplying the ample credit and just shoving liquidity into the markets at all points in time, right? This is to all the keepers of the system who are just making asset prices float up and to the right, regardless of underlying fundamentals, expanding PE multiples, buying stock futures in the overnight, as we've discussed before, so that all the gains actually occur before the markets even open. On and on and on. But it's starting, you feel the crescendo. I don't know what I would do if I was the Federal Reserve now. Because when this bubble gets pricked, this is going to be the most destructive bubble. It's going to make the great financial crisis look like a walk in the park.
Yeah.
I truly believe that it could get bad enough to trigger the great taking machinery, which you and I have discussed a lot in the past. And if people don't know what I'm talking about, we'll link some of the episodes, but everybody should be familiar with that, right?
Absolutely.
And against that backdrop, you have these mysterious things where our Treasury Secretary is like waxing on about how Bitcoin is like awesome, and I'm just like, this is starting to. I can't quite get the pieces to resolve, but I don't know what you do at this point. This is so big.
Yeah, and we're at the point. I mean, and the timing's the hard part, right? But there's no easy way out of this. Let's just assume, of course, we're hearing about the debasement trade. And that's kind of, tongue in cheek on Wall Street and investors that retail's even talking about the debasement trade at this point. But yet the dollar seems to be holding up. So, rates don't need to be cut because it's going to continue to fuel this bubble. But at the same time, you've got all kinds of defaults that are coming up to the surface right now, frauds that are being discovered more so than at any other time I've seen outside of 2007. But that was limited in the real estate space. In the late 1990s, it was limited to the internet space, but right now you've got it in property, you've got it in markets, you've got it pretty much everywhere, crypto specifically across the board with all of this excess leverage. So I just don't see how we get out of this without pain. We either get into a hyperinflationary event at some point, which I believe is much worse for the overall masses than what it is if you have deflation. And if we don't get the hyperinflation, we have deflation and all this house of cards, this Jenga pile comes apart, then it's going to wipe out an entire generation of baby boomers that have the largest exposure to equities that they've ever had in the past. If I may be off on that, but from what I understand, It is the largest exposure. I've just not gone to verify it, or at the highs that we've seen. So you've got a lot of people who have everything to lose that don't understand the risks that they're carrying under the surface because they're constantly marketed to from all these people that's trying to get into their pocket. And then you've got another subset of the population who doesn't have anything to lose. So why take, what's wrong with taking 5 times leverage if you can put $10,000 you're able to save and you're young? That might give you a chance, if you hit it right, to be able to buy a house because you're priced out at this point. And all the while, I've been hearing stories about, one of the major investment companies, BlackRock, I believe it was, and Blackstone. One of the things they do is they go in and they buy these whole subdivisions, or they buy these houses up, right? So then they sell it to one of their other entities for way above market value, which sets appraisals up across the board. And then they leverage across that area to go do it again across the board. That is fraud. That's fraud. And we don't have regulators that are doing anything about it. I mean, they want to bust people in the financial services industry because clients text them, on their cell phone, but yet you're ignoring all this other fraud that's taking place out there. I mean, that's one of the reasons clients have texted me is like, I can't text you on my cell phone. I got to go somewhere else because I don't want to be low hanging fruit. But we don't have anybody watching out for us. They're watching out for the people that are greasing their pockets and guaranteeing them and their families, these great pay packages on the other side. And if this comes apart, they're not going to have the opportunity that they thought they had either. I just hope that the truth comes out and they're laid bare and have justice for what they've done.
Well, I think we've all been hoping for consequences for people who deserve it, right? As we've learned now, Anthony Fauci was up to his eyeballs in creating and then hiding his role in helping to create, and the U.S.'s role in creating the COVID virus, right? So you'd think that would come with some kind of consequences, but none so far. And it just seems to be, we have that 2-tier thing, as you mentioned, like, down here in the trenches, the rules, there's a lot of rules and they do apply, but you go above a certain, you pop through some membrane and, and all of a sudden anything goes, and it's, there seems to be zero consequences for that, So steal $10, you're going to get in a lot of trouble. Steal the retirement funds of 1 million people. Oops, guess they should have been more careful.
Yeah, it's terrible. And the worst part is it's all targeting an excess at the middle class. Like there is a war against the middle class right now. We're at a point, especially with where the markets are, and this is what's so dangerous, and people don't want to see it. And unfortunately, you have to embrace courage to see reality for the truth that it is. Like I have on my screen, focus on reality, not be hopeful, because I'm a very hopeful person, very optimistic person, but I also want to pay attention to reality because the simple pass on, the prudent foresee danger and the simple pass on, the prudent foresee danger and hide themselves while the simple pass on and are judged for it. We all have to embrace prudence at this point because this is a long-term game. Right? If you're 65, there's a high probability you're going to live to life expectancy at 86, 87 or longer. We never know when the Lord is going to call us back. But just this emotion that you're dealing with in the past 12 to 24 months, you've got to pay attention on the big picture and the risks that if this isn't, this narrative has any deception to it at all, that it could dramatically alter the vision that you have in the future. So I believe that we have to be prudent right now. We have to have the courage to face the truth and look at mathematics and compare that to history, because history has a lot of lessons in it. And I don't believe that the education system would overlook history if they really wanted a wise populace, right? I mean, they don't spend a lot of time teaching the history lessons of the past to better arm our citizenry with wisdom for the days ahead. History doesn't repeat, but it does often rhyme, which if you look at it from the big picture, it's pretty dang close to repeating. And that's why I keep that up there. I mean, these are lessons that we learned from in the past. And you go back, who was it? The Tulip Mania, a brilliant scientist. I can't come to mind, but he got sucked up into it. And he knew he shouldn't, but he got caught into it and got wiped out in his wealth. It'll come to me here in a minute. But, brilliant people in the past have learned the same lessons that we're getting ready to learn at some point here in the future. And it's only those of us that are being prudent.
Look at that chart, though. If you look at the spaces, there's at least a generation between those peaks, right?
Oh, yeah.
Because people had to forget the painful lessons, right? So there's a little cadence to it, right? Because you wouldn't go straight from one bubble into another unless you were particularly stupid, right?
No.
This is my third bubble. I'm in my third bubble. This should not happen to somebody in a lifetime, right? So I don't even know what's going on now. You talk about the prudent versus the simpleton or the fool, right? This is foolish to get sucked up into a third bubble in a row. Just is.
It is. And I think the reason why that we've had so many of them in our period of time is that's 1637 with the tulip mania, 1720 with the South Sea, 1929, the Great Depression, gold in the 1980s, and then you had the 2000 .com bubble. But the difference is prior to, we were on an honest money system. So you had the gold standard that would anchor that reality down just a little bit. But now, since 1971, we left that gold standard. You got, 2000.com, 2006, 2017 with the initial Bitcoin bubble, 2021, Bitcoin again, then Tesla in 2021, and now you've got the everything bubble. And all of that comes from all of these, just the marketing power, the propaganda. I don't think it's a coincidence that in, 2013, Obama repealed the ability of the
Smith-Mundt Act. Yeah.
Smith-Mundt Act, to where the government could use propaganda on the American people without. So, if the government's going to do it, they're going to allow corporations to do it for their own benefit too, because they're going to just turn, look the other way.
Well, you make a great point, because, all that sound money, it takes time to clean up the wreckage from a bubble in a sound money system. But ever since 1971, we've had ample credit. There's been no tether on how much can you print, right? And remember, it was only 2014 when the banks themselves, the Bank of England, finally looked into it and said, turns out money's created in the banking system. Like, oh, you just figured that out, right?
Yeah.
Right? But they did, they just sort of figured it out. They wrote that paper, and very surprising. But yeah, so when banks create money out of thin air, of course, when they make a loan, like when I get a mortgage from a bank, they don't have 500,000 sitting in a vault somewhere that they dedicate to me. They go clickety click, here's your five. That's it. Money got created. That's credit. So we've lived in a very ample credit environment. It's allowed us to skip kind of from one to the next. And that's what the Federal Reserve did in 2008 and 9, is they papered over a massive problem that was caused by their responses and policies to the prior massive problem that was created by their policies and responses to the prior massive problem. We've just been in this like ever increasing amplitude and frequency of crises created by too much credit. Because when you have too much credit, Paul, people do stupid things with it. Right?
They do.
And who was it? John Stuart Mill said, panics do not destroy capital. They only reveal the extent to which it has already been hopelessly betrayed.
Oh, that's a good quote. That is a great quote.
So it's already been hopelessly betrayed. Like all those trillions that the Fed printed, it's already been dedicated into some really dumb projects that are never going to pencil out. They're never going to pay back. They're not what you would call a self-liquidating loan, right? You have a successful restaurant, you expand the seating by 50%, you take out a loan to do that. That has a means of paying itself back. It's self-liquidating. Most of this stuff is non-self-liquidating debt that we've taken on. We just spent it.
We just spent it.
Threw it into bubbles.
We did. And I think the greater mistake or the greater error in 2008 wasn't necessarily the printing, because I have issues with that. Okay, I do. But the fact that nobody went to jail for the fraud that was taking place in the halls of Wall Street, because basically what you did was you incentivized, you basically changed the rules of the game and said, look, one, if you can get too big to fail, we're going to force the taxpayers to bail you out. And then the other thing is, why not play the game? If you don't care about the customers that you're dealing with and the only thing that you're serving money is, why not leverage yourself to the hill and hope that you can pull the golden parachute before it comes apart on somebody else's watch? And hey, one thing that brings to mind too, speaking of pulling that golden parachute, let me see if I can find it here. Samantha LeDuc, which, I like the work that she does and her research as a trader, points out something from one of her followers, the accountant. 100% of the last top 200 insider trades were sells. and I love her statement, market, show me you care. And of course, this breaks it down, but 100% of the last top 200 insider trades were sells. And then there's another going back, and I did not know this. You know, I think we've talked about before that Buffett has, let's see here. Let me find it. That Buffett has the largest amount of cash on hand that he's ever had, right? Mm-hmm. So I want to highlight this too, because this is pretty important. So Chris Irons, quote the Raven, came out with the Buffett indicator just hitting an all-time high. Again, of course, it's hit all-time high, all-time high, all-time high, right? Mm-hmm. This is what I didn't know. So Stock Market News puts this out. Berkshire Hathaway has been unloading stocks for 12 straight quarters, the longest selling streak in his history.
Whoa.
I did not know that until this came out. So
3 years.
Yeah. Whoa. 12 straight consecutive quarters he brings this up. Quarterly net purchases and sales of publicly traded stocks for Berkshire Hathaway. That's a big deal. I mean, he's inside. He's connected. You know, and he said if, you know, this is selling with conviction. If Buffett was waffling, this is QE Infinity. You know, 100%, he's saying Buffett is right and the market's wrong. If Buffett was waffling, I'd say 50-50. It's clear he wants to dramatically reduce exposure to equities. Now, as I've shared that information with people, they're like, well, is it because he's retiring? Is it because he's doing you know, when you've been in the game as long as he is, with the knowledge that he's learned and the fact that he navigated. I remember Jim Cramer calling for his resignation because he was too old to understand the new economy in the late 1990s, right? Because Buffett was down, Berkshire Hathaway was down approximately 20% in 1999 when the S&P was up 20. But he positioned himself to be up over the next 3 years, approximately 38%. This is off memory, so don't hold me exactly to it, but I'm pretty sure it was 38%. When the S&P was down 47% over that period of time. We've shown the charts at some podcasts in the past. But these are people who are looking at the big picture. They have the courage to stay out of the emotions. One thing about Buffett is he sticks to his strategy. He has a strategy, and he understands that underperforming in the short run is necessary to be where you need to be in the long run for maximum opportunity. But few investors have the ability to do that because they're just constantly marketed to with information. Because the reality is these big investors have to have a market to sell to. And in my entire 27 years, as much euphoria as I've seen, I've never seen an environment where retail is so willing to gobble up the things that these insiders and the most connected are selling right now.
Well, as we said, not my first rodeo, certainly not Buffett's. He's been through tons of market cycles. And you know, Paul, there are always signs. There are always signs if you know where to look. So you mentioned like the depreciation schedule on these chips, right? And so, you know, OpenAI is going to, has 5 years, says Yahoo Finance, has 5 years to turn 13 billion of revenue into $1 trillion. Well, there's a problem because they don't have 5 years. It turns out, this is from Princeton.edu. This is a blog that goes into accounting issues. And in the center of this article, they said, quote, here's the puzzle. The chips at the heart of the infrastructure build-out have a useful lifespan of 1 to 3 years due to rapid technological obsolescence and physical wear. But companies depreciate them over 5 to 6 years. In other words, they spread out the cost of their massive capital investments over a longer period than the facts warrant. And The Economist has called it the $4 trillion accounting puzzle at the heart of the AI cloud. It's not a puzzle, Paul. This is so for people who may not get, you know, depreciation accounting, all this. Let's say you spend $100 billion on chips. Okay, not an unthinkable number in this day and age. Now, I'm going to expense that. I'm going to depreciate that over, say, I'll make this easy on myself, 5 years. So I'm going to take a $20 billion hit off of those things, and in 5 years they're gone. But oops, in 3 years, I'm going to have to buy those $100 billion in chips all over again. So now at 3 years, I've only taken 20, 40, 60 off. I still have 40 left on the books. Now I got another 100 I tack on top of that, and I start counting that down. And you just find that you have these expense things that you spent the money today, but you don't have to recognize the hits till later, you know, kind of a thing. And they just pile up.
Yeah.
This is easy to see. That's accounting fraud as far as I'm concerned, right there. And it masks the true nature of all that. So that's the kind of stuff somebody like Warren Buffett would just take one look at and go, yeah, when you have companies that are fundamentally fiddling the depreciation schedules to make things look better than they are from a revenue standpoint, that never pencils out. That always just blows up at some point. Whether you recognize that now or later, you don't have to wait. You can look at this and go, oh, they're playing accounting games. This is BS.
Yeah.
That's all.
And 2 points that I want to make. One, I want to go back to Buffett. Buffett's in a different situation compared to the average money manager that's out there, or even the average asset manager or advisor, right? So Buffett's at a point where he's reached escape velocity. He has, excuse my language here, but it expresses he has FU money, right? Like, so what if his investor is firing? He's fine. Okay, so he has the wherewithal because there's nobody above him telling him that you got to chase the bottom line for the next quarter to make these long-term decisions. If you're a money manager of a mutual fund, anything active at this point, your C-suite is breathing down your neck like crazy because they're going to fire you and replace you with somebody that hasn't learned the mistakes of the past cycle because they're worried about retail moving and going somewhere else. So he's in a position to make these decisions. And then the second thing that I want to talk about, you talk about the depreciation schedule. I actually built an Ethereum mining rig, and I cannot remember what year it was. I was thinking about this, but I called this firm out, but I can't remember, guys. So I don't know if it was 2014 or 16. It was early. But when I was trying to figure out Bitcoin and crypto and learn everything about it, I got to thinking, I was like, the best thing I could do is build one of these mining rigs. Bitcoin was too expensive at the time. Firm out of Atlanta wanted to charge me like $25,000 to build a 16 GPU thing. So me being me, I started calling local high schools and I found a kid that was he's brilliant. And I said, look, I'll teach you business if you'll teach me how to build this rig. So we built this thing for like $1,800, put 220 outlet in. My power at the office goes up by $250 a month. But for the first year, it was great. It paid for itself 30 times over. Then the second year, it was slower because new chips had come out. By the third year, it was completely obsolete. So I looked at reinvesting back into those chips. Well, these GPUs, not chips, but GPUs, at this point, it was like $25,000 to rebuild this thing to get it going again. So the risk reward was out. Now, if that's any indication of what they're having to do with these chips that NVIDIA is putting out there, the newer and, the cost may continue to go up. I don't know. But I've had that experience. You've got a short window of time where it's extremely productive. And if you don't reinvest, another company's going to emerge. They're going to invest into the new technology with capital. And it's this never ending treadmill at this point. It's not like the internet bubble where they laid all this fiber across the world that can still be used today. It doesn't have that 25, 30 year life cycle based on anything that I've looked at this point and what the analysts have stated.
Well, that's a great story. And let's flesh it out a tiny bit. Now, that story worked for you because you could cash flow that investment so that by the time it was out of its depreciable life, right, its useful lifespan was over, right, it had returned the funds. This is what the problem is, that right now OpenAI is going to put all this money into these chips that have no chance. I'm going to put this out there, Paul. They have no chance of returning that money in that before they have to be replaced.
Not that anybody can see. And let's say that it does what they say it's going to do. None of us have a job anymore, right?
Yep.
Then who the heck's going to pay the subscription to be able to pay for their services at this point? Like don't get me wrong. I fully believe that it's economically changing. There's a major impact throughout time, but the narrative that we have today, is that the correct narrative? That I don't know. Or is it like the car replaces the horse, right? The adoption curve was huge. Internet completely changed. iPhone completely changed, our interactive life, the apps across there, the business opportunities that came up. But this seems like it's one ring to rule them all is what it is. And if that's what comes out, then what are we all going to be on? UBI at this point in the future? And then we've seen, all, depending upon anything. Just look at what's happening with SNAP and the government shutdown right now. There's a lot of people who just don't know what to do, right? Because they've become reliant upon a handout. Some need, some don't. And now they don't know what to do. I mean, is that the position they want to put us all in? I know there's a lot of individuals like me that will do whatever I can possibly do if the Lord grants me the wisdom to stay out of being, reliant upon somebody, the government to cover our needs.
Oh, exactly. So since you touched on it, this is now officially the longest running government shutdown in U.S. history. And I'm starting to see crevices here and there where, and I don't totally understand it yet because I need to see all the moving pieces, but apparently we're starting to see liquidity issues showing up here and there. Just for example, if the SNAP shutdown, that's $38 billion a year. So what is that? $3 billion a month of liquidity that's flowing into the system and flowing through the entire food chain system. But you've got government salaries that are like frozen at this point in time. You've got lots of different moving pieces that are just clogged up at this stage. And by the way, I don't see anything on the political front. I'm no giant political like Sharpie, but I don't see anything. I don't see. It looks like a stalemate. I don't see any budge on this at this point in time. So
it sure does. And and look, the Trump administration is not facing a debt ceiling, deadline like we have during most of those in the past. So theoretically, they could carry this for a while. And both sides think that they have to absolutely make a stand. I like Thomas Massey's argument. Hey, let's just break this down to one bill at a time and let's vote on this thing.
There we go.
Obviously, we've got some people that are getting SNAP that shouldn't be, and there's people that need it. So let's just address that. Let's fix the program, right? And then let's move to the next thing. But nobody seems to be willing to sit down at the table and negotiate for the American people. And again, I know this. I try to use analogies that everybody can understand. I grew up in a household that suffered a nasty divorce. Okay, and the bitterness between father against mother was so severe that I was fortunate because I had athletics. There was damage that was relayed down to the family, so I can talk about this in experience, and I've seen it time and time again take place. And no parent actually chooses to get this full of bitterness and hate towards the ex-spouse, that they choose to hurt their kids in that. But that's unfortunately what happens, especially if we don't have people that are willing to speak into our lives and call us out for our misbehavior in the midst of emotion. And that's what these politicians look like, right? Who's calling them out for it? Because they're certainly not listening to the people. And I think these big corporations are sliding money here and there for their own benefit. And this animosity is, pitted against Democrats versus Republicans, and it's delivering all kinds of damage to the people who need those benefits when they should be focusing on getting those people off that shouldn't be on there, and focused on helping those people that need that help.
Well, and that's just one area of government. So yeah. I do agree also with Thomas Massey saying, hey, as long as we're at it, why don't we just keep the Department of Education shut down?
Yeah,
they've spent $4 trillion. Arguably, we're in worse shape than we've ever been from an education standpoint on a peer adjusted basis. So when you have an entity that spends lots and lots of money and you're going the wrong direction as a consequence of that, spending more money does not make sense, right? Might as well shut that down and try again.
No, and it's funny because with Holly being an educator, and Holly gives me a hard time. She's like, don't say on the podcast all the things I'm complaining about. But yeah. I'm just the type that I don't want to put her head on the chopping block. But with my staff, with kids in the school system, the comment was made not too long ago. It's like, we've had 2 weeks worth of, Spirit Day every day. It's at what point is enough, right? It seems that they're more interested in programs and entertainment within the school system than they are in actually preparing these children for the future that they're going to face. And I'm a big believer. My daughter's having a child, and somebody gave me this advice. The most important thing that we can do to our kids right now in the future generation is build them to be mentally strong and develop problem-solving skills, because the economy is changing fast over the past 20 years, and it's going to change even faster. in the future. And by all historical measures, they've got a lot of challenges they're going to face in the future. So our school system doesn't need to be making it all about entertainment. It needs to be preparing mentally strong, problem-solving kids that can adapt to whatever change. It's not learn this and you're set for life. It's learning problem-solving skills so that they can adapt to what comes in the future and having the mental strength to accept the reality and fight instead of rolling over and giving in to despair.
Well, that lays a lot at the feet of the schools. So I'm a big, we homeschooled our kids. So I'm a big fan that most of those life lessons begin at home. I just don't want the schools undoing them
right.
teaching them the opposite of those things, which they are, right? They're inarguably failing in large measure. Switching gears slightly, we did get a reader comment from last time where Dar Sims said, "Hey, I enjoy your podcast. Just listen to your interview of Larry Lepard. You both talked about food inflation as if food commodities are high priced. I'm a fruit farmer in Idaho, and we are selling apples for the same price as we did 30 years ago, priced in dollars, not gold. Onions, potatoes, grains, and beans are all priced in today's dollars, close to what they were 30 to 50 years ago. Only beef is high priced. To the extent there's food inflation, it's all related to cost and profit after it leaves the farm. I think you should point this out when you discuss food inflation." Thanks, Dar Sims. Thanks for that, Dar. I have pointed this out at several points. You probably missed them, but Paul, I'm offended when I see these charts of like corn, where it's the same price per bushel in nominal dollars, the same price per bushel that it was in 2008. I can't think of any other industry that had, besides commodities, that has to somehow, because of how the game is played, put up with not being A, in control of their pricing, and B, having to put up with pricing that's set by somebody else. It levels where it was 20 years ago. Think of another industry, right? Can you imagine if Ford trucks had a futures market and the futures market insisted that Ford trucks were only worth the same dollars they were in 2008 and Ford had to just eat that? They'd be out of business in no time. It'd be terrible.
And the exact same thing that would happen in the farming industry. Well, I think it's nefarious from a lot of the policies, because what it does is it keeps the family farmer from being able to sustain from a long-term standpoint. It takes the profits out to where the next generation wants to go somewhere else. And it opens the door for these major corporations and institutions that want to control us to get in there and capitalize upon that, and then give them all the ability to charge whatever they want once they've monopolized the industry. But you're right. I mean, it redirects investment. The only benefit, if it happened to Ford, would be good for all of us that are consumers, as prices wouldn't be 5 times what they should be.
Yep.
But again, their profits are good. Okay. But because that means you've got a sustainable business and you can offer services to the people, because we all have to have these different services in our life. But the greed that goes upon that, and you're putting your boot on that family farmer for the expense of Wall Street, is something that this administration said that they were going to change. But now it's like, hey, we're going to keep Wall Street where they are, and we're going to try to pull you all up together, but keep that gap. That's what I heard with Basant's tweet. And I'm careful what I responded, but I did, have some smart aleck comment to it. But
today's markets are more volatile than ever. With ongoing economic and geopolitical uncertainty, navigating such environments requires thoughtful, adaptive strategies, not a one-size-fits-all approach. At Peak Financial Investing, our registered investment advisory firm connects clients with experienced wealth managers who focus on active portfolio management. These professionals use evidence-based strategies designed to respond to changing conditions, not outdated formulas, but customized approaches grounded in research, discipline, and risk awareness. We believe in open, informed conversations, including discussing tools like precious metals and diversification as part of a broader financial strategy. Every investor situation is unique, and our advisors tailor their guidance accordingly. Visit peakfinancialinvesting.com today to schedule your free consultation and explore how proactive management can support your financial goals. I'm Dr. Chris Martenson, proud to work with Peak Financial Investing, and my support reflects my professional views. I encourage you to take control of your financial future by making informed decisions. Guess what? Markets are up again, Paul. Yay, the stock market's up. But you and I both know that's really just the big seven dragging everybody up at this point in time. But I wanted to talk about now how the real economy is actually doing. So the real economy is real people buying real things. I didn't pull it up here, but Chi Girl on Twitter had pointed out that the corrugated cardboard companies, because if you're going to sell something, you put it in a box and then you ship it. That corrugated cardboard is usually a pretty good indicator of what's happening, and those companies are just tanking right now. And then you got the trucking side of that. This is from the FreightWaves CEO. And let me just, I'm going to have to do one adjustment here to this so I actually have audio with this. Bring this up. Let's go.
Well, we should be worried. The goods economy, certain portions of the goods economy are collapsing right now. So year over year trucking volumes, this is really the predominance of freight that moves across the United States, is down 17%. It's important to unpack exactly what we're talking about. Is the retail freight, freight tied to the trucking market, which is really local distribution, is actually flat. So it's not seeing deterioration. It's probably why the Federal Reserve isn't overly concerned, because the consumer is staying pretty persistent. You see it in a lot of the retail earnings. But when you look at the industrial sectors, the folks are the freight that moves over the long haul. This is energy, automotive, housing, and manufacturing. We're down 30% year over year, which is very great financial crisis levels of concern.
30% year over year for the industrial sectors. And also, Paul, inventories are building up big time. And this could be related to tariff tantrums and things like that. But again, that's pretty significant. Year over year, trucking volumes down 17%. We haven't seen a hit like that outside of the great financial crisis. So just how do just 7 stocks manage to power all of this up and get us into this situation? It's starting to, we're getting that departure between Wall Street and Main Street, right? That just everything's separating. This is pretty shocking data right here, as far as I'm concerned.
Yeah. Well, and Richard Russell, we talked about that before. I really miss that he's passed and the work that he put out. But, he paid attention to the transports versus the industrials, because the argument is if the economy is weakening, you're going to see it in the transports first. And we're seeing that across the board, and we're seeing it in the consumer staples space. And
we're starting to see these popping, creaking sounds, right? Because you mentioned, there's like these scams and frauds and bankruptcies that are going on, mostly again from the outside in. We're seeing a lot of that happening in the subprime space, but this isn't subprime. And I have to ask it again, Paul, who's sitting on all these losses? Somebody's holding the bag here. This is commercial mortgage-backed securities. Delinquency rate is now higher than it was at the height of the great financial crisis, higher than the oil bust, which caused a lot of CMBS paper to go down, particularly in Houston area and things like that. You have the recession way back there in 2000 to 2003 or 4. We've never seen anything like this.
No.
Somebody's eating. Like, where are these losses?
I don't know. And I want to know who's allowing them not to mark them to market, because you're seeing weakness in, I've heard it's regional banks. Mm-hmm. And you're seeing weakness in the regional banks, but not to reflect the level of crisis that's taking place right there. You hear that it's in some of the insurers potentially. Maybe they're not having to mark them to market, and that's one of the reasons why our premiums are going up across the board. But where are the regulators that are allowing them to get a bailout at the taxpayer's expense if that is the case? None of that makes sense to me right now. None of that makes sense.
Massive losses sitting in this, though. This just massive. And
that's massive losses. Massive losses.
Well, all of this is to say that, what do they say? Printer is coming. Hearkening on the Game of Thrones thing. But I do think that we're in a situation where it's clearly obvious that the Fed's going to have to start printing again. They'll make up some excuse. And with that, we're going to see the resumption of inflation. And by the way, I think we're going to see inflation come back, well, to the extent it's rising prices. But we put this thesis out, I don't know, a month ago, right? Which was that, hey, if we get that double hump 70 style inflation, where you had that 73 to 76 inflation, it calmed down for a bit, then you had the 79 to 80 whatever inflation, right? That double hump. But that was driven in no small measure by two things, right? Bad monetary policy, but also energy costs. I think we're going to see the energy costs particularly for natural gas here in the U.S. for a variety of reasons. We're not getting more out of the ground for some reason this year compared to last year or the year before. So it's kind of static, but LNG terminals are coming online. Data centers are coming online. And we're starting to see that reflected in people's electricity costs, right? Nationally, 35% over the past 3 years, but locally up as much as 200% over the past couple of years. Places like New Jersey, Northern Virginia, stuff like that. If you happen to be, unfortunately, near a data center, which, as we just described, may be in a bubble.
Mm-hmm. That's right. And we're seeing continued frauds that are popping up across the board. That's one thing I think I'd mentioned to you. I've not seen this many frauds pop up across the board and just money just disappearing from a fraudulent standpoint, which means less leverage that's in the market. I've seen them from time to time, but not this many that are coming out, and the market doesn't seem to care right now. I think the market does matter in certain other areas, but this AI narrative is continuing this euphoria, the willingness to take on leverage, but that leverage can be a curse. Just ask the over-leveraged Bitcoin individuals when we had that, 10 or 12% decline that happened a couple of weeks ago that just absolutely wiped people's entire accumulated paper balances out overnight.
But that's, there's a passage, I'll have to dig it up. It's going to take me a while to find, but Will Durant wrote this big, long series of history books, great stuff. And I remember reading this passage that was back in Athens 2,000 years ago. And they were going through a monetary debasement cycle. And the passage, it just read like today, Paul. It's like, well, with the debasement of the currency, it turned out that speculating was an easier way to, make money or try and advance yourself than doing hard stuff like actually working or opening a business or anything like that. So when they talked about all the different effects it had on the society and how a whole generation decided they didn't want to work, they'd rather speculate on the inflation trades, the debasement trades. Well, they were right. Humans behave according to incentives. When you have a money printing regime, your best and your brightest go and chase that because it's so much easier than growing a sack of potatoes and marketing it, So you get a lot more bang for your buck. The problem is if you do that long enough, that becomes your economy. And so, of course, the cautionary tale is Athens after that declined and, was not a reasonable power after that. So when you go through and you ruin your system of money, it has very long-lasting impacts on the greatness of your culture.
It does. Hey, and I tell clients, like our dividend strategy, one of the requirements that we have in our dividend strategy is the company hold back at least 30% of the revenue. I don't want them to be paying out 100% of that revenue because you need them to reinvest into the future ability to grow that company. And when you're in the speculation phase, the reason it's going to take so much longer to rebalance and get back to that foundation again is because that lack of investment when you get into financialization over time is not easy to rebuild, right? It's great that we can bring manufacturing back into our country. That's awesome. But you got to get the infrastructure. You got to train the individuals. You got whole manufacturing sectors where we don't have anybody here who's experienced in it anymore because it's been gone for, the individuals that had knowledge of it are out. It takes time to learn those things. And especially when you're in a competitive environment, is China going to send people over here to train us? No, they're focused on taking care of their citizens. So, I'm really concerned about what I see because, we're seeing, you've been talking about creaking and popping. I mean, there's just snapping and explosions taking place under the surface in all areas right now. It's much louder and much more violent than what it was before. But I'm reading articles the other day. It's like, you've got the reverse repo issues that's taking place right now. And look, I don't understand enough about all the dynamics behind that to actually teach people or do it in understandable analogies. I understand it enough after I read these, 5 or 6 times to grasp it a little bit. But here's the argument. There are people, there are institutions and investors and analysts that are giddy over the fact that we're starting to see issues in liquidity out there. because they're saying, hey, not only did they stop quantitative tightening, but they're going to have to reinstitute quantitative easing and slam rates to zero, and the market's going to soar. Well, it may be a reflective action to begin with, because you've got this, I think the algorithms have fear of missing out built into them at this point. Otherwise, that chart that you showed a minute ago on a reinvestment you can't explain wouldn't have taken place. And that, if it does give us a surge that lasts for another 6 months per se, when that happens, but you still have this deterioration under the surface, it's just going to suck more people into this narrative and cause more damage on the other side, because we're at a point right now that is just not sustainable. And look, we're exposed, okay, to the market because it makes sense right now. But each and every day, my head's on a swivel looking at everything. Like, is today that the information changes? Do we get a sell signal today on this position? And if it happens, there's times where you can wait a week or two to let it see, but this is not a time. Sell signals mean they have to be acted upon immediately, because those decision points have to be considered, because the consequences at this point and the downside risk built into this market is going to happen quickly whenever it starts unraveling.
Well, indeed it will. And I would just like to direct people to this. This is the Peak Prosperity website. And here you see I write things like the Fat Pipe, and Dave Fairtex writes a really amazing once a week Sunday article. And this one was the Fed. It's great. People love this thing. But this is our last one, Paul, which I titled Snap, Crackle Pop, and cucumbers versus grapes. So you see, we got, people are over here. So if anybody wants to comment on these and catch my attention or Paul's attention, you should come to the Peak Prosperity website and comment on it there. I don't always see them on YouTube necessarily. But in there, have you ever seen this? Have I shown this to you before? The famous cucumbers versus grape monkey experiment?
No, I've heard about it, but I've not seen that. So if you've got time to play it, let's watch it.
It's the best 3 minutes on the net.
So a final experiment that I want to mention to you is our fairness study. And so this became a very famous study, and there's now many more, because after we did this about 10 years ago, it became very well known. And we did that originally with capuchin monkeys, and I'm going to show you the first experiment that we did. It has now been done with dogs and with birds and with chimpanzees, but with Sarah Brosnan we started out with capuchin monkeys. So what we did is we put two capuchin monkeys side by side. Again, these animals, they live in a group, they know each other. We take them out of the group, put them in a test chamber, and there's a very simple task that they need to do. And if you give both of them cucumber for the task, the two monkeys side by side, they're perfectly willing to do this 25 times in a row. So cucumber, even though it's really only water in my opinion, but cucumber is perfectly fine for them. Now, if you give the partner grapes, the food preferences of my capuchin monkeys correspond exactly with the prices in the supermarket. And so if you give them grapes, that's a far better food, then you create inequity between them. So that's the experiment we did. Recently, we videotaped it with new monkeys who had never done the task, thinking that maybe they would have a stronger reaction, and that turned out to be right. The one on the left is the monkey who gets cucumber. The one on the right is the one who gets grapes. The one who gets cucumber, note that the first piece of cucumber is perfectly fine. The first piece she eats. Then she sees the other one getting grape, and you will see what happens. So she gives a rock to us, that's the task. And we give her a piece of cucumber and she eats it. The other one needs to give a rock to us. And that's what she does. And she gets a grape. And she eats it. The other one sees that. She gives a rock to us now, gets again cucumber. She tests the rock now against the wall. She needs to give it to us. And she gets cucumber again. So this is basically the Wall Street protest that you see here.
That's good, Chris. That's information everybody should know.
I agree because fundamentally what the Fed does when they print money and hand it out to the 0.1% or the 1% or wherever you draw the line, they're handing grapes. And the rest of us are getting cucumbers, right? And this creates things I think we just saw in our election cycle. People are willing, they get desperate. They start shaking the cage. They'll vote anybody, anything in as long as it looks like, hey, how do I get some of those grapes, right? So if you have a deeply unfair system of money, it's very hard to have a fair outcome in your society, right? Now, I'm not saying sound money fixes everything, but it would go a long way. It has its own issues you got to deal with. But the system of money we have today, Paul, is fundamentally unfair, and it's been run in a deeply unfair way by a succession of Fed chairmen, and with Washington's complete abstinence from overseeing it or doing anything fair about that, right? Maybe shipping our jobs off for NAFTA or something. So that's the system we're in right now, and I think people need to be aware of that, because when bubbles break, they have social consequences, and that's when that anger that we saw there sort of pops up. But hey, for the love of money is the root of all evil, but we happen to love a system of money that is fundamentally corrupt at its core. It's yes. Grapes for them, cucumbers for everybody else.
Yes, that's right. And that's how you get mandamis. It is.
That's how you get, yep.
And the thing that's so sad to me is we're not seeing any changes in this administration. We were promised changes, but we're not seeing it at this point. And that's even more infuriating. But, all I could think as a side note was I'm watching value investors throw good, high quality stocks out from a long-term standpoint because it's not, generating the returns that the AI are for people. And it's hard, right?
It's hard.
It's so hard. And that's why I spend so much time on research, so much time on trying to question the narrative and look, is because the average person just doesn't know. They're caught up in life. They're trying to get by. Expenses are going up. They're trying to help take care of their families. They're trying to make sure they get their jobs. They're trying to learn. I mean, society is moving so fast now that those of us that have a role to help provide a service for individuals have to do everything that we can do to pursue it with excellence and be the best. Understanding you're going to make mistakes, but don't make the same mistake twice. And I wish if everybody had the understood the scripture, do everything as if you would do it before the Lord, right? That means that it's not for us. If we provide a service and we do the research that can benefit people in the long term, everything else will take care of itself. The problem is we're in a society right now where those politicians are not working for the people. They're working for the people that can line their pockets the most. I mean, the corruption is absolutely clear out there. They've been able to stack the judicial system to protect themselves, and the average person just doesn't know what to do. So they look and they see other people getting grapes. They don't realize the risk of what they're doing, and they well, I'm going to try that for a while. And when it comes to an end, it's going to bring a lot of misery to a lot of people.
Well, it's intolerable to see the other people getting grapes. So you will do what you need to see if you can maybe get your hands on some grapes. But of course, that means you're going to take excessive risks, or maybe you don't understand the actual game that's unfolding because it's opaque, right? By the time the Wall Street Journal can't even by a couple weeks researching and tell us where the money flows are in the AI without resorting to some fancy loopy charts and we don't know, right? By the time we're seeing advanced accounting tricks to sort of hide the actual expenses and stretch them out longer than the lifespan of the underlying assets that they're buying, we've been here before. That's why you have that chart over your head.
Yeah.
This is a very ordinary, usual, normal thing. And here's the other, I said there were two characteristics of bubbles. There's actually another one, which is that by definition, it is impossible for the majority of people to get their money back out of one.
Oh, that's good. That's right. That's true.
A few can, right? There's always a few cases of somebody who sold the Semper Augustus bulb or backed up the South Sea stock and took livres out of the gold coinage out of the Bank of France, etc. There are a few people who did that, and they actually did quite well for themselves, generationally well in some cases, for their families. But most people, that's not the story.
No. And people need to remember, in a bull market, it's easy to make money. I mean, there's people that are going to challenge that statement. I challenged it when somebody told me that when I was 20 years old and or 22 when I entered the workforce and started trying to make it. But one thing that I have discovered in working with families and individuals that have been very successful over the past 27 years, it's easy to make it, it's hard to keep it. And especially in an environment like this, it may feel good making it, but when you're this detached from historical fundamentals and the math doesn't add up, the market's an escalator up and an elevator down. Actually, at this point, I'm concerned it's a free-falling elevator down to when we get back to reality. So be careful. I'm not saying you have to sell. There's no way I would short this market right now. I was amazed. Michael Burry's got some backbone because he shorted NVIDIA and somebody else here recently.
And Palantir, I think.
Palantir. Yeah. And what was it? I saw a report, 650 PE. So if their earnings stay the same for 650 years, it would take, that's classic signs of a bubble. And maybe his gift is being able to see these things unfold, but he's putting his money where his mouth is. Now, I'm not doing that for clients. If I did it for me individually, that's one thing, but I'm not willing to short a market with this much euphoria and fear of missing out right now. You're better off, especially with my concern about the great taking and whether the derivatives market is going to actually hold up or not. You're better off to follow the decisions and take the most conservative path right now when it does come time to sell.
Absolutely. Well, I think that's all the time we have for today, Paul. So I'll remind people that if you want to talk with Paul and or his amazing team, just go to peakfinancialinvesting.com, fill out a simple form, and somebody from Paul's office will be in touch with you within 48 business hours to set up the first of what should be 3 calls: an introductory call, a review of your situation call, and then a recommendations call. And every one of those would be well worth your time. It's no obligation. So I would also recommend that if you are thinking of doing that, you should try and do that before one of these elevator shaft moments happens, because then Paul will be very, very busy with people who've all decided that now would be a good time to finally make that call.
Yeah, that's right. And just to tell everybody that's out there, our industry unfortunately spends more time focusing on potential new clients than they do their clients. So it takes a while to get in. Just know that it takes a while, because we put a lot of effort into that planning process, because I want to make sure that I keep capacity in my schedule. So if I have a client that I'm serving needs something, then I'm available for them. And so it's not that we're not interested, but we're setting up, because our first responsibility is to the people that we're engaged with and we're serving. And then once once somebody does become a client, if it's appropriate, they get the same treatment. They're first. So that's the reason why it takes some time to get on my schedule from time to time.
Excellent. All right. Well, with that, everyone, thanks very much for listening. It's been wonderful being here with you. Again, leave comments, and we'd love to engage with those. And we'll see you next week.